Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Hello, welcome. Today we're talking about high yield and emerging market bonds with Amy Xie Patrick, Head of Income Strategies at Pendal Group. Amy's had a very interesting background. Amy, perhaps if you'd like to explain and talk a little bit about your career history.
Sure, and thank you for having me on, Liz. My background, as Liz has mentioned, is quite varied. It started off in emerging markets on the sell side. So I was a market maker for Citigroup for 3 years at the beginning of my career. And it was around about the time, so this was 2004 to 2007, when emerging markets was really taking off as an asset class. And not only were sovereigns issuing debt, but corporates started to issue more as well. And from there, my career expanded to looking at high yield markets globally, both in emerging markets and in developed markets. And of course, the world's largest high yield market is still the US high yield market. So I'm talking to you today with that background, that sort of mix of experience. But today, I actually manage a range of portfolios focusing on delivering stable and reliable income to our investors. And so a lot of my job currently depends on thinking about when to rotate my asset allocation between the growth-loving and the risk-loving parts of my portfolios versus the more defensive parts of my portfolios.
That's so good. Such important and varied experiences, really great for our listeners. So just before we start, perhaps can you explain the terms high yield and emerging markets? What do they mean and what countries are included in emerging markets?
Yeah, that's such an important question, Liz, because I think, as broad terms, they do get bandied around quite a lot in the industry. So for me, high yield means corporate debt that is not investment grade rated by the key rating agencies. And these rating agencies, such as S&P and Moody's, tell us, whether they think something is investment grade, which generally means it's a safer type of issue, a safer credit, or non-investment grade, sub-investment grade. So the high yield universe looks at the latter, things that are not considered investment grade by the rating agencies. But more than that, I think to be included within high yield or investment grade indices, you also have to pass certain criteria that the index managers themselves set. A really good example I can give you most recently is, I'm sure a name that everyone knows, it's Netflix. So Netflix has been investment grade rated by at least one of the three major rating agencies for quite a while, since 2021. But it's only now that it will travel from the high yield index into the investment grade index. And that's because it's taken this long for it to satisfy market liquidity requirements set by the index providers. So what does that mean? It means that when you're moving from a lower quality type of asset class into a higher quality type of asset class, you need to carry with you as an issuer a level of market liquidity that allows a larger audience to trade your debt. So without having passed this criteria until most recently, despite being investment grade rated and no longer high yield rated by the rating agencies, Netflix wasn't able to travel into the investment grade universe until most recently.
That's just so fascinating.
Yeah, it is, isn't it? And I think a lot of my colleagues found that interesting recently as well, because they didn't realize that Netflix had even been upgraded, let alone that, it was ready to enter the investment grade index. Now, that second question you asked, Liz, what counts as emerging markets? Again, we can have a real world definition, which is usually economies that are less developed usually on the industrialization spectrum. They usually would have a lower level of growth and GDP, as well as a lower level of income per capita. So they're your sort of standard academic definitions. But again, within markets, we apply other criteria because we need these instruments to be at a certain level of liquidity that is tradable and investable by a wider audience. And at the same time, because we are investing in debt instruments and these emerging market either governments or their corporates could face crisis and might not be able to pay us back. So we also need to make sure that we understand that the rules and regulations pertaining to especially defaults and mispayments on debt are clear enough that we're able to invest in these asset classes. So that is broadly, what I would define as to be high yield instruments and emerging market instruments.
So Amy, why would investors choose to invest in those sectors of the market?
The simplest answer for you, Liz, is because they offer higher return So a lot of the investors that I tend to speak to like that high yield offers you, exactly as it says in the name, a higher yield. It offers you greater participation in the upside. This is when, especially when equity markets are doing very well, being exposed to high yield rather than, let's say, investment grade or even government bonds means that when the sun is shining, you can make more hay. You can get more yield, and probably you can get more capital appreciation in these bonds as well when the economy is doing really, really well. Similarly with emerging market economies tend to be quite heavily concentrated in commodities producers and exporters, and we know that commodities tend to be positively correlated to the economic cycle. So again, when the global economy is doing really well, when our demand for resources is booming, when our demand for global trade is growing as well, this is a time when emerging markets tend to do quite well. So investors tend to go into these types of asset classes within fixed income to get a higher return profile within fixed income itself.
So obviously with higher risk, there's going to be higher return, but there's obviously some other risks. Can you talk about those as well, please?
Absolutely. So, one thing we said earlier is that one of the things that makes high yield bonds high yield is that the rating agencies don't rate them as investment grade. Now, what does that mean when they're sub investment grade? It doesn't mean that you shouldn't invest in them, but it simply means that you go into these instruments, go into these debt instruments, knowing that they carry more risk. And one of the most obvious forms of risk is obviously that the company doesn't pay you back. Quite often, defaults happen in the corporate sector, not because companies can't pay you back the principal. We know about the defaults earlier because before they even get into that kind of trouble, they just can't simply afford to pay you your coupon payments. And some of that has been going on a lot within the Chinese high yield space. And I know we'll talk about that a little bit later on, Liz. So debt default is definitely one of the higher risks that you have to take by going into the high yield market. Not necessarily the same with emerging markets, though, and I would say that especially with the sovereign space. So emerging market sovereigns, as an aggregate, still tend to be rated around about the investment grade level. That doesn't mean that some sovereigns won't default on their debt, and then we know that Argentina has time and time again defaulted on their debt. Then a new lease of life was given after the restructuring was completed, and then off they go again. But on the whole, emerging market sovereign debt tends to follow a slightly different credit cycle. But emerging markets do suffer from other types of risks, such as being exposed to the global cycle, and most importantly, being exposed to what the largest economy does, or rather what their central bank does in terms of monetary policy. When the US leaves their monetary policy fairly accommodative, fairly easy, it means that dollar liquidity conditions in the global economy are quite easy as well. And a lot of emerging markets do rely on US dollar funding to be able to carry on doing, their main lines of business, sovereigns and corporates included. But when the Fed has been tightening, as they have been for the last 18 months and tightening quite aggressively, it makes global dollar funding conditions quite tight. And usually for emerging markets, this poses quite a strong headwind, both in terms of their growth outlook as well as for their currencies. But this time around, it's actually been a little bit different for emerging markets.
So interesting. What sort of yields could investors expect in these markets, and do they vary much between different economic conditions?
Look, right now in US high yield, so I'm going to talk about the index that most market participants would be familiar with when we talk about the high yield market in the US, and that's the Bloomberg Barclays High Yield Index. And currently, that if you were exposed to that sector, it would pay you a yield of about close to 9%. I checked this morning, and it's paying you around 8.7%. But it's tempting to look at that yield and think, oh wow, that's such a lot of yield. I can get nearly 10% a year by investing in these names. And because it's a diversified group of names, then maybe not all of them will default when defaults do happen. So that seems like a good return. But what's important to understand is that of this 8.7% that you'll be paid in terms of yield for this kind of exposure right now, 3.9% is the compensation that you'll be getting as an investor for taking on that extra credit risk, for taking on that extra probability of default within this asset class. The rest, so close to 5%, is actually what we refer to in the market as your risk-free rate. Now, that's a little bit controversial because risk-free implies that there is no risk, and obviously there is risk in it. But what we mean by risk-free is that there is no credit risk, or there shouldn't be any credit risk relating to the rest of that yield, because that yield comes from US government bonds. And US government bonds, whether we like it or not, are still classified as the safest assets in the financial space that you could hold in your portfolio. The US government, is not expected to default on their obligations when their bonds come due, and when their coupon payments come due, they will pay you. So only less than 4% of that chunky yield, that chunky 8.7% yield, only relates to high yield right now. In emerging markets, it's a little bit less. As I said, the quality of the emerging market sovereign index is higher than US high yield. It's probably a little bit lower than in US investment grade. Now, US investment grade gets you probably a credit spread of around 100 basis points right now over the risk-free rate. So let's call it about 5 to 6% in terms of yield. Emerging markets will be somewhere between that. But there is a huge amount of variability, exactly as you said, Liz, in terms of the amount that these yields, and especially these credit spreads, the components of the yields that compensate you for taking that risk in that asset class, can vary over the cycle and depending on economic situations as well. We know that typically in times of economic stress or recession, this spread on high yield bonds, what I said earlier, was around about 3.9%, so let's call it 4%. It has more than doubled during the global financial crisis. We saw it at 20%. So this is the amount that these spreads can really fluctuate when things get really dire for economies.
So obviously yield is going to fluctuate wildly, and you would expect loss years investing in high yield and emerging market assets. Do you want to talk about that? Sort of your rough expectation of number of loss years out of 10 years sort of thing?
That's an interesting question. So, because of the higher yield that you do get in these asset classes, typically out of every 10 years, you wouldn't expect your loss years to be greater than one. We say that of these types of asset classes that are higher yielding, whilst they do carry more risk, the yield generally compensates you for the losses that you might suffer over the course of a cycle. But that 1 year when you do suffer losses, it will be quite painful, to say the least. And it will take several more years of earning the yield on this asset class to make up for those kinds of losses as well.
Okay, moving on to high yield specifically. Australia's high yield market is in its infancy, and many Australian companies issue high yield bonds in the US. Can you talk about the advantages for them to do that?
Yeah, so in Australia, there isn't much of a high yield market, right? I think, it's a fairly niche area of the fixed income market for most investors. And especially in recent years, within the Australian market, you've had a lot more issuance out of the banks, both majors and the smaller banks in the lower tier two space. And they definitely offer a little bit higher yield. And it just means that for a fairly conservative market like ours, both in terms of the issuer space and in terms of the investor space, investors just go to the names that they know well. So if they're happy to own CBA senior unsecured debt, and they're happy to own CBA equities, then they're probably going to be more relaxed about owning the lower tier two paper. And most of the lower tier twos in Australia are still investment grade rated. They're not sub investment grade rated. So the high yield market, because it's so underdeveloped in Australia, a lot of our high yield issuers do prefer to go towards the US market, where the audience is just larger. They're able to get away, they're able to issue more size, which means from the company's perspective, they're able to borrow from the market a larger quantity of funds, which will help them to do, whatever course of business that they're trying to do at that point in time. But also when they come to needing to roll that debt, so when that bond that they issue matures, and they need to go back to the market to ask, well, this piece of bond is maturing now. I would like to issue a new bond so that I can continue to borrow from the market. The chances of that market remaining open to them is so much higher when they're issuing into the US market compared to if they're trying to do the same thing in our small and underdeveloped high yield market. So market liquidity and that access to the market is a really important factor for our high yield issuers customers to look elsewhere to be able to issue their bonds rather than our own markets.
Just talking about the US high yield market, can you describe how big it is and the influence it has? I know it's massive.
It's you say that it's massive, Liz, but actually it's not that massive. So the US high yield bond market is currently at about 1.3 to 1.4 trillion. That is a massive number. I do know that. But as a percentage of the total global bond market, so this is everything, all bonds, as a percentage of the total global bond market, it's just slightly over 1.5%. It's not massive by any stretch of the imagination. You know, when I think about the investment grade market in the US, it's 3 or 4 times the size of that. But what is interesting about the high yield market, though, is since the global financial crisis hit in 2008 and 2009, what you've seen in the US high yield market is another branch start to split off. And that branch is called the leveraged loan market. The leveraged loan market is actually a little bit larger than the high yield bond market in the US. It's currently at about 1.6 to 1.7 trillion. And that high yield bond and the leveraged loan market taken together, so all of these assets are sub-investment grade rated, taken together, the size of that asset class has actually doubled since the global financial crisis. So that is, quite phenomenal. The fact that a big major event that involved lots of defaults could happen, such as the global financial crisis, but then since then that whole asset class can double in size as well. But to put things maybe in a little bit of perspective, and I know we'll talk about emerging markets a bit later, but the whole emerging market universe is close to 30 trillion. So the US high yield market, when compared to that, it's big for sure. It's much bigger than even the investment grade market in Australia, but it's still relatively small compared to some of the other credit asset classes that we see in the world.
Oh, that's so good. Thanks for clarifying that. There's a tremendous amount of capital needed for energy transition. Are you investing in that sector?
Energy transition, it's become so topical because obviously, 2022 was such a great example of a year to make us understand as investors how punishing it can be to cut a whole sector, a whole segment of the market out of your investment universe when you jump onto a theme in the wrong way. And that theme is obviously sustainable investing and ESG. So we're huge supporters of the energy transition. The transition has to happen in order for us to get to that new state of the world that is more sustainable. But when we think about it within our own investment criteria, and especially pertaining to our ESG standards, we probably think about it a little bit differently to the rest of the market. We're much happier to invest, for example, Western Australia issued some semi-government bonds fairly recently. And those semi-government bonds were classed as green bonds. And we chose to invest in them with a decent amount of pushback from the broader audience because, Western Australia is where we dig up everything. It's where we mine for all our commodities. It's a part of Australia that is known to be relatively a bigger polluter, a bigger contributor to our overall nation's carbon footprint. So why are we investing there? And the transition is the key point. Western Australia, a lot of what it digs up is essential to helping us build out that infrastructure for this economy's transition. And more importantly, what that state has done is 2 years ago, it set out a whole list of transition policies and objectives and goals that it wants to achieve by a set timeline. And this bond marks a really crucial step along their journey. So we think of investing in the transition as being really crucial. So there are plenty of issuers within Australia who very opportunistically are happy to issue under the name of being a green bond or being a sustainable bond. But when we think about what these issuers are actually doing with these proceeds, whether it was a green bond or not, they would have issued anyway, and those proceeds would have been invested into the business the same way that they're saying it should be invested under a green set of circumstances or a sustainable set of circumstances, because those funds would have helped to get their businesses further ahead of the competition and just progress those businesses along further. It's just normal course of business. We apply a more stringent lens in terms of thinking about investing in the green and sustainable space, and especially with a view to really wanting to support a solid transition effort within our domestic economy as well.
Just thinking again about the US, if it goes into a recession next year, how would you expect that to impact high yield margins, and would defaults likely increase?
Defaults would definitely increase. Defaults always increase when the US economy hits a recession, however mild that recession is. And one way to monitor for where defaults might go is there is an indicator in the market called the Senior Loan Officers Survey. So this is a survey conducted for all of the US banks. Senior loan officers in banks typically decide what lending standards ought to be within that institution, whether they should be tightened or whether they can be loosened. Typically, in a hiking cycle, when central banks are taking up the level of interest rates across an economy, it makes banks sort of want to pull the reins in. And the way that they do that is when the senior loan officers respond to the survey that says, are you, versus the last quarter, going to tighten or loosen your lending standards? The senior loan officers start to tighten. They start to say, well, we're probably getting some signs through our books that some of the smaller and more fragile companies within the economy are starting to face some difficulties with payment, difficulties with liquidity. We don't really want our book to suffer too much in terms of quality. We don't really want, non-performing loans to start ratcheting up within our book. So we're going to tighten our lending standards. Now, when those lending standards start to tighten, defaults will follow, and they typically follow with a 12-month lag. And because we have so much foresight, given the leading indicator of the Senior Loan Officers Survey, we already know that whether or not the US even goes into a recession next year, 12 months from now, default rates within the US high-yield universe are likely to hit about 10%. So that's already a given.
Wow, that's high.
Yeah, that is high, isn't it? And that's definitely not what's in people's sights right now. When you talk to the rating agency, I'm sorry if I sound very scathing about rating agencies, but they do tend to follow rather than to predict. And every time they've come out recently to say, well, this is the latest set of defaults that we're seeing, and defaults in the US are still very low. They're around about 2 to 3.5%. But every time they come out with a new set of here are what the defaults actually are, they come out with a new set of revisions, and those revisions for their forecasts have been going higher. Now, so far, Moody's and S&P probably still only expect US high yield defaults to climb to about 5 or 6%, but we see the numbers as being likely higher over the next 12 months.
I'm still picking up my chin off my desk from hearing that 10% default rate. Let's move on to emerging markets. So some emerging market economies are tied to the US dollar, and a lot of them are actually. What impact have US interest rate rises had on some of the major emerging market economies?
We touched on this a little bit earlier, and it's such a fantastic question because you're right. Emerging markets as an asset class, especially when they issue, corporate and sovereign debt to the rest of us, they tend to do it in US dollars. And there's a little bit of history behind this as well. But the main reason is because once upon a time there was a group of investors concentrated on the West Coast in the US that said, what's another way for us to get more yield on our portfolios? The high yield market is one way, but the high yield market back then was probably a lot smaller than it is now. So let's find some other ways that we can get some diversification into our portfolios, and therefore the emerging market asset class was born in terms of the debt space. So that's why a lot of emerging markets, both credits, so corporate bonds and government bonds tend to be tied to US dollars. They tend to issue first and foremost in US dollars. And therefore, when the US is tightening its financial conditions, it tightens financial conditions for emerging market economies. And typically, like I said earlier, this poses a really strong headwind for emerging markets. It poses a headwind for their growth prospects. It means that in their local currency terms, as dollar funding conditions get tighter and the US dollar strengthens, they have to gather more funds in their local currencies to be able to pay back that debt, or even to fulfill the coupon payments on that debt. And the more that they have to dedicate towards paying back their debt to foreigners, the less they can spend on their own economies to try and boost growth, or at least try to soften the fall in growth if they're going through a recession themselves. So when dollar conditions have tightened exactly as they have done in the last 18 months, it tends to be a particularly hostile environment for emerging markets. But this time around, it has been a little bit different for emerging markets. And I think one of the key reasons is because whilst the developed market central banks sat around and said at the beginning of this inflation episode, oh, it might be transitory, so we're going to wait for a while, emerging markets have seen this time and time again, and they were not prepared to wait. So you've had economies such as Brazil, where throughout their hiking cycle, they hiked, almost a year before the Fed started to hike, they took their interest rate up from the low single digits all the way up to nearly 14%. 14%. And all the while trying to stay ahead of inflation in that economy. And as a result, that economy hasn't cratered. We haven't gone into a recession in Brazil. The economy has still remained incredibly resilient. But as a result, it's gained, for Brazil and its central bank, an extra level of credibility, monetary policy credibility, that I would argue is a little bit scarce in the developed market central banks right now. And for that reason, these economies that have kept their real interest rates in positive and quite high territory, it still makes emerging markets as an asset class quite appealing from a global investor's perspective. Because when you think about real interest rates, in Australia, we've got our interest rate at 4.1%, but our inflation rate, according to the latest quarterly numbers, is at 6%. So our real interest rate is actually negative right now. And so as an Australian investor, if you could only pick between two things, investing in Australian bonds or investing in Brazilian bonds, you'd probably choose the latter because it would give you a positive real yield. So it's those kinds of calculations that have meant that emerging markets as an asset class, even though they should have been put through the ringer over the last 18 months, they've actually been incredibly resilient.
I'm learning so much. Thank you, Amy. There's obviously quite a range of performances across emerging market countries, and you like Brazil. Are there other economies that you would find attractive in that sphere?
Yes, absolutely. So I do like Brazil. It has been probably one of my favorite emerging market exposures throughout, the last year or more, and it probably continues to be one of my favorite exposures. But one of the reasons I like it, by the way, it's not just for the real yield story, but it's also because it's exposed to the potential upside that you might get out of China, because we know that China as an economy is down on its knees right now. But if we saw a little bit of positive impetus coming out of that economy, the resources exposure within Brazil, the resources, being exposed to iron ore, it means that it has more upside potential if China were to be able to, get its act together at this point in its cycle. But other countries that I like include are probably also still quite resources facing. So the Mexicos of the world and the Indonesias of the world. Again, similar to Brazil, very much like the policy credibility that they have over there. I jotted down a few numbers earlier so that we could compare and contrast. But Indonesia has a cash rate of 5.75%, but an inflation rate of only 3%. Mexico has a cash rate of 11.25% and an inflation rate of 4.7%. Whereas when we talked about Australia earlier, but when you look at the US, it has a cash rate of 5.5, but a core inflation rate is of still somewhere quite similar to that, 4.7. So these emerging market central banks, they've really given themselves a lot of credibility throughout this cycle. But what I like about Indonesia in particular is that despite it being, in Asia and probably more subjected to the headwinds that the Chinese economy is throwing on it right now, throughout this COVID crisis and thereafter, it's really focused on making sure its sovereign balance sheet is as strong as possible. It's really focused on reducing deficits. It's really focused on making sure that its current account deficit is well within its control. And all of these things lend credibility to an emerging market sovereign issuer's credit status. For Mexico, it's a slightly different story. I would say that from a policy credibility perspective, they've always had it. But what Mexico is really benefiting right now is the strength of the US economy. Whether we like it or not, and we've been talking about recession probably as a market for over 12 months, and it's still not happening in the US. And one of the key reasons is because US fiscal policy is still incredibly supportive as we get into the bouts of another election cycle, and Mexico, with its proximity to the US, just benefits from the trickle down effects of a very strong US economy. So that's one of the reasons why I like Mexico as an emerging market issuer as well.
Just before we go on with my next emerging markets question, I realised talking about the US government, I should have asked if a change in US government next year would impact the high yield market there. Do you see that impacting?
Yeah, a change would probably at the margin cause some impact to the US high yield sector. But I would say that probably the changes for US high yield as a whole will be more impactful in the run up to the elections because, let's be honest, what run up to any US election has seen fiscal spending go backwards? And it's that fiscal impulse that makes the cycle kick on for a little bit longer. So if the cycle kicks on for a bit longer, not that we will avoid seeing those 10% default rates, but that those default rates might be a little bit more delayed. It might buy us more time to get those higher levels of carry and yield out of the high yield asset class. Now, in terms of a change of government, if that change of government means that we see Donald Trump again, we know that, during his last time in office, a lot of deregulation happened. And some of those deregulations did provide lubrication for the economy. It just meant that the red tape was removed and, businesses could go on with doing whatever they needed to do without a lot of admin and bureaucracy involved in it. So that's definitely a good thing for the economy. But we saw some of the other things that came about that's only washed out more recently in terms of the deregulation that happened under the Trump years. And that was changing the regulation for banks reporting. So before Trump deregulated this particular rule, it was any bank that was over the size of 50 billion in terms of total assets needed to report on their unrealized losses within their books, and then those unrealized losses needed to be offset against the capital that they had to hold as well. And under Trump, that ceiling got lifted up to 250 billion. So all of a sudden, all these smaller banks no longer needed to report on the losses that were happening on their books until all of a sudden we got an accident like SVB. Now, accidents like that are definitely more prone to happen in an environment when regulation is being rolled back. Regulation is there for a reason, let's all remember. Removing some of the red tape is helpful, but it also removes some of the safeguards for the broader economy as well. So the structural trend after a change in economy, change in government, especially if that means going back to another set of Trump years, is being prepared that as regulation continues to get rolled back, you will get the potential for more accidents to happen.
Okay, big deep breath. Let's flip here, and could you perhaps talk about your thoughts on the Chinese economy and its property market? We saw Evergrande default finally. Perhaps you'd like to share your thoughts.
Yes. Look, I don't think we've, any amount of time is enough time to really cover the Chinese economy well. But I'll just say one key thing. The property market is China's biggest issue right now. It is the Chinese economy, and it will continue to constrain the growth potential of that economy. And there's no way to get around this. For China, what it did to itself during 2022, in terms of its zero COVID policy, that was a much easier thing to reverse. What it's done to itself in terms of deleveraging the property sector, it can't go back on. And it shouldn't go back on, quite frankly, if it wants its economy to survive for the next decade. But what has happened more recently, and you mentioned Evergrande filing for Chapter 15 is just part of its long and drawn-out default process. And that already, the big shock of that news already hit us last year. What is happening now is another issuer called Country Garden. Country Garden has some, I think, 2,000 to 3,000 unfinished building projects across the whole of China that would be suspended if that company were to go into default. And already it's missed 2 major coupon payments on its US dollar bonds. So clearly that company is under a lot of stress. And the reason all of these property developers are under stress is because the government has tried to limit the amount of debt that property builders within China can take out. So they introduced a policy called the 3 red lines. And I won't bore you with the details, but they just really restrict these property developers' access to funds. And it left them with one channel open. And that channel was being able to pre-sell their unstarted projects to customers. When they get the funding from those pre-sales, unlike in Australia, pre-sales go into escrow, nobody can touch them. In China, those pre-sales are a key source of funding for property developers. And even though the 3 red lines were introduced, and so these property developers were no longer able to go to the banks and go to the bond markets to get more funds to leverage up their balance sheets, they were still able to pre-sell for much of 2021 and 2022. But more recently, those pre-sales have halved and halved again. So what does that mean? It means that their key source of funding that was left open to them has now been shut as well. And the reason that's been shut, it's a bit of a chicken and egg problem. When you're a customer, when you're a household thinking, oh, I might like to go and buy a flat or a house by XYZ developer, but oh look, secondary prices in the property market are tumbling. That's not really going to increase my appetite to go out, either borrow funds or use up my cash to go and buy that extra house. So pre-sales have fallen off a cliff because prices have fallen off a cliff. Prices have fallen off a cliff because property developers have been defaulting, like the Evergrandes and most likely like the Country Gardens of the world. So this vicious circle problem within the Chinese property space is exactly what's clogging up the Chinese economy. To give you a sense of the magnitude, real estate assets count for about 70% of Chinese household wealth. 70%. This is how underdeveloped the Chinese financial markets are. So for most of us, I do think property probably does make up a large amount of our wealth, but we would, typically have savings elsewhere. We have our supers. China's safety nets are not that developed, and people have developed their own safety nets by speculating and buying into property, investing in property. 70% of household wealth. It also counts for 40% of banks' collateral when they're lending to the private sector in China, be that corporates or households. So the property sector being clogged up the way that it currently is really does hold the economy back. Whereas there are other parts of the Chinese economy that look to be flourishing, they look to be booming. It's what the president wants in China. He wants these newer parts of the economy, so be it EVs, battery development, investing into green energy, to be the new growth lever within China. And whilst they are growing really strongly, they only account for about 15% of Chinese GDP. The property sector and everything that's involved within the property sector account for more than 20% of Chinese GDP, and that is going backwards. So until they resolve this problem, China's economy will find it very difficult to stabilize at current kinds of growth rates.
That's just fascinating, Amy. In the context of the around the world trip we've had, how are you positioning your Pendal portfolios?
So earlier in the year, I would have said, probably along with the rest of the market, that recession is definitely in our on our radar, at least for the US economy, if not for Australia. But we've had more data since then. And the data is telling us that not that recession can be avoided, but that it can definitely be delayed. So I've talked a little bit on this podcast today about the fiscal impulse that you're seeing out of the US economy, whether that's to do with the Inflation Reduction Act or whether it's to do with more structural types of fiscal support that is going towards infrastructure. It's something that the economy definitely doesn't need right now because it's strong enough to sustain itself. The US consumer is, against all odds, having spent a lot of its post-pandemic accumulated excess savings, is still spending like, money's going out of fashion. And very similar for Australia as well, and we're getting the benefit of having immigration return to our shores. But immigration is having a double-edged sword sort of effect on our economy because whilst it's helping us replenish our labor supply, it's also driving up the demand for rental housing, for example, and just driving up demand across the whole economy. So within my portfolios, I do think that you're probably entering a spell of, let's say, the next 3 to 6 months, where the major economies in the world, and that's including the US and Australia, can probably tick along for a little while longer. Now, we are still watching the potential for those default rates to rise in the US, and when default rates rise in high yield, it takes credit spreads wider everywhere in the world, regardless of what's actually going on with the companies that have issued these bonds. That's just the nature of how markets work. And so within my portfolios that are exposed to Australian credit, I have preferred to keep those parts of the portfolio fairly conservatively positioned. So I have gone up in terms of seniority where I can, taking into account, what happened earlier this year with Credit Suisse and the hybrid bonds, and getting wiped out whilst the equity got something back. You don't want to be exposed to that sort of lower down the ladder kinds of quality exposures. I'm also very conscious of liquidity on my portfolios. I want my corporate bond portfolio to be as liquid as it can. We all know that liquidity in those kinds of instruments dry up at the drop of a hat, especially in Australia. But a higher quality portfolio means that you get to retain more liquidity through there as well. But on the other hand, I have preferred to keep a little bit more risk in emerging markets in my portfolios where I can, whether it be in the credit space or whether it be in the FX space, the currency space. And I balance all of that off with a little bit of duration. So that means exposure to high quality government bond type risks. So whether that's in Australia or whether it's in the US, because we've seen time and time again when stresses happen in the market, when equity markets fall suddenly and sharply, or when recession expectations suddenly skyrocket, those high quality government bonds tend to do very well.
We've covered so much today. Is there anything else you'd like to add?
No, I think we've, as you say, we've done a big tour of the world. The main message that I would probably leave the listeners of this podcast with is, today we've talked a lot about these higher yielding parts of the fixed income market, but it's important to remember that there are times of the cycle to want to be more exposed to those sorts of parts of fixed income. But then there are other times of the cycle, especially if you disagree with what I've said on this podcast and you're expecting recession sooner, whether it be on our shores or in the US economy, in which case it should be time to dial back those kinds of exposures as well. So timing your exposures into these racier parts of the fixed income market throughout the cycle is critical to ensuring that the fixed income part of your portfolio continues to behave like fixed income when you want it to.
Amy, you have been absolutely fabulous. I have learned so much, as will our listeners. Thank you so much for your time, and I hope you'll agree to come back sometime.
Absolutely, and thank you so much for having me. I've really enjoyed our chat.
Thank you. Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.